Hey guys, welcome back to Evolve or Die. Today, we're going to be talking about a lot of different things. We're going to be talking about some economic conditions that affect the market. We're going to be talking about business cycles, also known as the economic cycle, and the conditions that affect these cycles. We're going to be talking about some monetary policy coming down from the Federal Reserve. We're going to be talking about just really a lot of influencing factors of the market and what affects price action, and really helping you guys be able to identify trends and understand what's going on during these trends and what's going on, right now, and what is the economy, what state is the economy in right now. So we're going to go ahead and dive right in. This is the first thing we're going to talk about, guys, is the economic cycle. So something that is good to understand from a beginner standpoint is the economic cycle. At any given point, the economy is in one of these cycles. It is going through one of these phases within the cycle. So the economic cycle is a fluctuating state of the economy from expansionary periods to contractionary periods. So what we see here, and there are a lot of contributing factors that go into measuring exactly what phase of the cycle that we're in at any given time. So we are going to talk about a little later in the video exactly which phase of the cycle that we're in right now currently. But to go back into the cycle, so the measure is to show you the conditions and what phase of the cycle the economy is in any given time. So the factors that influence this often include employment rates, consumer spending. So like you can find out this information. They're just looking up the consumer price index reports. They're available through the Bureau of Labor and Statistics. I'm sorry. And interest rates are all used to determine what phase we're in the economic cycle. So at all given times, every economy is either in a period of expansion, a peak, a recession, coming down, and about to enter an expansion, which is what we call the trough, that little dip that you guys see here. So at any given time, we're in one of these phases of the cycle. And the current cycle that we're in right now, the current phase of the cycle that we're in, you can see here, Fidelity does an amazing job with providing cycle updates, which I think is incredible. They provide so many different business cycle updates for not just the United States, but globally and internationally by country. So it's really great. And as you can see here, so we're measuring the US here. We're looking from Q4, the end of 2020 to currently right now, we're in Q3 of 2021. So what you're seeing here is the inflationary pressures back in Q4 of 2020. They were not as high, before all the stimulus money started rolling out and before the vaccines and all of the, the CARES Relief Act and all of that stimulus money. So as we enter the end of Q4 and we enter the beginning of 2021, we're in a recovery, we're in an expansionary period. And if you just go back to, the beginning half of this year, you will see reflected that, the Dow Jones, the S&P have been hitting record highs every single day, like for the past few months. And so we were really in a period of recovery and expansion. We saw so many companies hitting all-time highs. We saw just a lot of positive economic outlook with the rollout of the vaccine. And just to give you guys an idea, this is kind of what I mean when I'm saying that there are so many influencing factors that affect the conditions of the economy or affect the stock market, because it all has a reaction. So with that positive outlook, with that sentiment of economic recovery and the implementing of the stimulus money, we're seeing the inflationary pressures slightly going up. I think during Q1, that's when the first or the second round of stimulus checks were being released. So with that recovery, with that expansion, with that positive sentiment from society, like, the economy is reopening, travel is about to resume, there is a lot of things going on that's contributing to this phase that we were in of recovery and expansion. The economy's opening back up. So this is what we saw Q1 of 2021. Q2, we're seeing, a lot of inflation here because we saw the stimulus checks that were passed during Q2 to equivocate to $2,000 per American. And we saw that, I believe that was a $1.2 trillion stimulus package that was released, and like another round of CARES grants and things like that. And we did see eviction moratoriums extended. Landlords were not in a favorable position there. So there are a lot of influencing factors that made this transition from that recovery expansionary phase that we saw in Q1 to Q2. So we're seeing more inflation. We're seeing the beginning of the contractionary period. So right now, here we are in Q3. We are officially in a phase of contraction again, and this depends on what measures you want to, what do you want to gauge the state of the economy by, whether it's the CPI report, whether it's inflation measures as we see here, and the relative performance of economically sensitive assets we see also having an influence on the factors that Fidelity has chosen to create their model off of. So this is what I mean when I'm explaining how many things there are that affect the market. And there's a lot of things that also contributed from a monetary standpoint during this phase between Q4 of 2020 and Q1 of 2021. And we're going to talk a little bit about some monetary policy now. We're going to talk about quantitative easing. So quantitative easing is a monetary policy in which a central bank, ours, i.e. the Federal Reserve, purchases long-term securities from the open market in order to increase the money supply and encourage lending and investment. So what does this mean? Essentially, quantitative easing is when it's basically the reverse of tapering. So monetary policy in the form of quantitative easing, I'll give you guys an example. A few months ago, when the Federal Reserve hired BlackRock in order to help stimulate the economy. So we're going to take a little bit of a dive into how the Federal Reserve interacted with a lot of institutions in terms of ETFs and mortgage-backed securities as a form of very unconventional monetary policy to stimulate the economy. So as a part of one of the stimulus packages, a form of quantitative easing that the Federal Reserve engaged in was purchasing corporate bonds, ETFs from BlackRock. And this is significant because BlackRock does manage a lot of the Federal Reserve's debt in terms of yields and in terms of debt buying programs. So this is a form of quantitative easing, and another form of quantitative easing is keeping interest rates very low. And what does interest rates being low have to do with the stock market? Well, a lot of retail investors trade on margin, but hedge funds trade on a lot of leveraged margin. Now, what is leveraged margin? It's trading on borrowed money. So when interest rates are low, that provides more incentive for hedge funds to borrow more money, to trade on more leveraged funds on more margin, in turn causing the corporate debt to skyrocket. And what happens when hedge funds are encouraged to, trade recklessly and incur more risk because those rates are so low, it puts everyone more at risk for just all around disaster. When the hedge funds play recklessly, historically, the banks, the government, they get bailed out. However, this is just another, this is another form of quantitative easing, is keeping rates artificially low. And with that comes a lot of corporate debt. So just what to take away from this is when rates are low, people want to borrow money. Like borrowing at low interest rates that's a bank's dream, a hedge fund's dream. So again, like we discussed, these policies and these interactions that the Federal Reserve is having with different hedge funds and asset management companies, these are forms of quantitative easing. And we talked about what quantitative easing was. It was essentially buying those long-term securities. So those long-term securities come in the form of whether it's BlackRock's ETFs or other mortgage-backed securities. And remember how we talked about these conditions. So this condition, the quantitative easing and this monetary policy that the Fed was sending down through the economy had a huge part in this recovery and expansionary period that we saw in the end of Q4 2020 and the beginning of Q1 2021. So now we're going to fast forward to currently. Right now, we are in a cycle of contraction. So the economic cycles are just like the stock market. Inevitably, there's always cycles. What goes up must come down. There will be corrections. So after the peak, what comes? There's a sell-off. So when you start to research this, when you start to study it more, when you start to observe more, when you start to pay more attention to things that are going on globally, you will be able to identify the trends that I'm talking about. They will start to come very naturally and almost intrinsically. You'll just be able to you will be able to figure out and you'll be able to know, oh, what are the economic conditions right now? How is the market going to respond to this? So this is just an overview, guys, of those conditions that we talked about, the conditions that are going to indirectly influence what phase we're in the business cycle or in the economic cycle. So again, we're in Q3, quarter 3 of 2021, and we're in a phase of contraction right now. So what does that mean? That means we're in a phase of slower growth. Expansion recovery is the complete opposite of contraction. So right now we're going to see aggregate demand probably shrink a little bit. We're going to see reduced liquidity across the board. We're going to see tightening of monetary policy. So quantitative easing and expansionary monetary policy is going to directly impact the recovery expansionary phases of the business cycle. So the opposite of that, the paradox of that, the reciprocal would be contractionary phases are directly impacted by tightening contractionary monetary policy, i.e. tapering. So in the upcoming months, we are going to hear the Federal Reserve announcing some policies regarding tapering. What is tapering? It is the exact opposite of quantitative easing. Tapering is the reduction of the rate that the Federal Reserve purchases new assets. So we're going to see, like we talked about, this is the first step to that tightening grip on the monetary policy. They're turning off the money machine. Jay Powell, he's turning off the money machine. And we're going to see reduced liquidity. We're going to see slower growth. We're going to see aggregate demand shrinking, okay? And once the desired targets are met, i.e. once we hit a target inflationary rate of 2% or beneath, that is when banks will start tapering their spending, because if they keep engaging in the expansionary policies, i.e. trading on leveraged funds or loaning out loans with really low interest rates, then what does this lead to? This leads to hyperinflation and bubbles. So we're going to see a direct parallel in the stock market that's going to directly reflect the conditions that we're in right now. So people are getting scared about COVID again. People are getting nervous. People are masking back up. There are growing public concerns regarding women's rights. There's social unrest that is brewing. There's social unrest that's brewing. There's fear about a vaccine, or I'm sorry, not about the vaccine, about the, well, there is fear about the vaccine, but there's fear about this new strain, the Delta. I think there's probably like an Epsilon and a Zeta, and there's like every strain now. But what I'm trying to emphasize here is there are so many conditions, there are so many influencing factors that contribute to the state of the economy, the condition that we're in. And all of these can help you gauge a good entry point for a high conviction stock that you're interested in. So historically, stocks perform worst in September. And this, I'm sure this is correlated to a lot of different things, tax reasons, monetary policy, like we talked about. There could be a lot of reasons for that. Earnings coming out at the end of Q3. So there's a lot of different things that affect the conditions of the market. And like we talked about, we are in a phase of the business cycle at any given time. And next, we're going to talk about a little bit about how the market has responded to everything that's going on in Afghanistan. So this was actually a surprise to me because the market seemed to respond very positively to the news of an impending attack on Afghanistan, which I found to be really interesting. But in hindsight, having an insight into history and knowing a lot about the interconnectedness of like the international political economy, war means money. War equals money, whether it's like for natural resources, whether it's like for a pipeline, whether it's for, to defend our fallen soldiers. Money comes from war. Like war means money. So that was a really interesting dynamic, how we saw a lot of markets that were really green, like upon the news of, we're going to send a drone strike over. So I thought that was pretty interesting. And it's also going to be really interesting to see how the crypto space responds to this pending provision in the infrastructure bill that's going to be discussed sometime after September 20th, whenever Congress decides to come back, whenever they, I think they're only in session for like 100 days out of the year, I believe. Anyways, it'll be really interesting to see how this bill affects the markets, because if the taxes are, I'm sorry, not the taxes, the provisions, if the provisions applying to brokers and the KYC requirements are categorizing, delegators and stakers as brokers, then it's not a good position to be in, like in the crypto space, because it's impossible. Like what they're asking is impossible. Like if you run a staking pool and you then tell all of the stakers that they have to produce identity documents, like you have to produce, most of these stakers, like they don't know who the people are, like they don't know who the stakers are, they don't know who's delegating to their pool. It's completely an open forum, and asking for the KYC would just be, for every single person, is just like, it's not realistic, because it's not clearly defined like what a broker is, or like who is considered an exchange. So there's a lot of things going on, guys, like, and I just really wanted to talk about these different phases, like the phases of the business cycle, because having an understanding of how the economy functions is a really great starting point to like understanding these trends that you'll find within the stock market and the catalyst events that directly impact the markets and the phases of the cycle that we're in. So that pretty much sums it up for today, you guys. I really wanted to give you guys some insight about understanding like how monetary policy affects the markets. How does the Federal Reserve, keep interest rates artificially inflated? Like we're gonna have another video about the money machine too, but that's for a later day, you guys. Until then, keep evolving, and until next time, friends.